Welcome to an episode of the LoVasco Briefing, where we equip retirement plan sponsors and fiduciaries with the insights they need to make informed decisions. Today's episode is our second quarter 2025 market and economic overview, and we've got a timely, data-packed conversation ahead. I'm joined by two of our consultants from our retirement plan consulting team, Jim Chapman and Chris Schuppe. Together, Jim and Chris walk through the major market themes that define the second quarter of the year and what they could mean for retirement plan committees heading into the second half of 2025. We start by reviewing the S&P 500's continued strength, up over 7% year to date, as well as the volatility introduced by unexpected tariff announcements. Chris unpacks the timeline and impact of those events, while Jim walks us through how market valuations have evolved and what today's elevated price-to-earnings ratios suggest about future returns. We then zoom in on the so-called Magnificent Seven, tech giants like Apple, NVIDIA, and Microsoft, and their outsized influence on index performance. You'll hear how returns looked with and without those companies in the mix, and why that matters for diversification. Next, we discuss valuation dispersion within the S&P 500 and why this might be a particularly fertile environment for some skilled active managers to add value, especially in sectors that are trading at extremes. We also take a look at style box performance, where growth continues to dominate, but smaller caps lag amid higher interest rates. And speaking of rates, Jim provides a detailed update on the Fed, inflation trends, and where interest rates might go from here. Later in the episode, we examine the implications of AI-fueled capital investment, review the ongoing normalization of the yield curve, and discuss the case for global diversification, where international markets are currently outperforming their U.S. counterparts and trading at substantial valuation discounts. We wrap up by talking earnings trends and what we're watching most closely in the back half of this year. If you're responsible for overseeing your company's retirement plan or just want to stay sharp on what's driving markets, this is a conversation you won't want to miss. So let's dive in. Well, welcome to the Q2 market and economic overview for LoVasco. I'll move on to our first slide.
So this graph represents the S&P 500 at different inflection points going back to 1997, covers major market events as we look at 2000, where we saw on the heels of the technology bubble that burst in 2007. We saw the financial crisis that occurred. Moving out to 2020, where we saw COVID, and into 2022, where we saw a little bit of a downturn. But it's been interesting since the financial crisis in 2009, the tremendous bull run that we've seen in the S&P 500. With the exception of those 2 points of COVID and the downturn in 2022, when we had major inflation. And we continued on this path as we look at 2023 and 2024, where we had really banner years in the S&P 500. 2023, we were up 24%. 2024, we were up 23%. Really being driven by a lot of the growth in technology. And we continued on that path as we turned the calendar into 2025. We were anticipating a very strong year in the market until the discussion of tariffs came about at the end of March and leading into April, which was very disruptive to the financial markets. Markets do not like surprises like we saw, especially with the abrupt introduction of how those tariffs were going to be and how severe they were going to be, much different than what we heard during the campaign. However, since that time, we've really corrected. It's been amazing how resilient markets are. We're on a year-to-date basis, we're up about almost 7.5%. As of the date of this recording, on the 21st of July, actually we saw a market height in terms of the S&P 500. But if we look at the last 3 months alone, the S&P 500 is up 23%. So we're still anticipating a very strong year in the markets this year, if, depending on how we see tariffs play out. What has been interesting is the valuations, PE ratio, which is price to earnings ratio, which is a measure of really how expensive a security has become or a stock has become. And we've seen it move from really what the 20-year average would be at around 15 and 19% in that range, where we were at the end of the quarter on June 30 at about 22%. times earnings. So it has been a little bit expensive to buy into the market.
Thanks, Chris. And moving on to valuation measures, Jim, what do you have here?
Yeah. So kind of building off what Chris had mentioned, through June 30th of 2025, forward price to earnings ratios sitting at one of the record highs. We're at about 22 times price to earnings ratio. As Chris had mentioned, price to earnings ratio is something that a lot of analysts will look at to understand how over or undervalued the market is at a certain time. The only other points throughout history where we've seen the price to earnings ratio exceed 20 times price to earnings was back in the late 90s and early 2000s during the dot-com bubble. And then more recently, following COVID in 2021 and early parts of 2022, we saw valuations become very inflated. If we think about what was happening during both of these points of time, back in the late 90s and early 2000s during the dot-com bubble, there was a lot of hype and momentum around these new internet stocks that were coming about, and people were really excited to invest in them. And so they were paying premiums to buy into these internet securities. Obviously, we saw a correction ensue following the dot-com bubble. More recently in COVID, following the correction that we saw in the early parts of 2020, the market rebounded in a really strong way. It was up about 120% from the low in April of 2020 through 2022. But what's interesting about that is the economy was still relatively slow and shut down. And so while the stock market was rising, a lot of the companies that comprise in the S&P 500 were not producing very strong earnings. Earnings were either flat or lower than expected, causing this price to earnings ratio to really inflate. If we kind of think about where we stand today as of June 30th, 2025, and what's causing these valuations to inflate again, it really has to do with the trajectory that we saw over the last 2 years in some of the more growth-oriented names. So I know we're going to talk a little bit about this later on, but we're all familiar with the Magnificent Seven, seven of the largest stocks in the S&P 500. Primarily, they're in growth and tech sectors of the market. They're trading at extremely high multiples, and they've really had record years over the last 2-3 years for the S&P. And so some of this is driven by the rapid growth we saw among the Magnificent Seven. Some of this is driven by just the broad market. But what's interesting is if we think about why is it so important to keep an eye on valuation measures, it's because typically it is a good forward indicator of what's going to come in the next several years. So if we go to the next slide and talk about price to earnings ratio and how this relates to potential future projections. So on slide 5, we're looking at two charts. The first one on the left-hand side of the page is showing us the forward price to earnings ratio and the subsequent 1-year returns. And the chart on the right is showing us forward price to earnings ratio and the subsequent 5-year annualized return. Now, for each of these charts, the vertical axis or the y-axis is the return, and the x-axis or the horizontal axis here is the forward price to earnings ratio. When we look at the 1-year annualized returns, there's really not much rhyme or reason or trend that we can pick up on. Valuations and returns are kind of scattered all over the board. But as we have longer term periods to evaluate, just a law of averages, we can start seeing a tighter and more normal trend exist in these forward price to earnings valuations. So when we're looking at this, lower valuations historically have been tied to higher potential returns. And conversely, as we look out over into the higher price to earnings situations, historically, this has resulted in lower historical returns from a 5-year annualized basis. And so, again, when we see price to earnings ratio at 22 times, it gives us a little pause. And kind of makes us look for two items. First one, is the market overvalued right now? And maybe number two, are earnings going to begin to justify the price of some of these securities? So again, we don't want to sit here and be pessimistic about what we're expecting to 2025. When we do see valuations in these types of ranges, it just makes us a little more cautiously optimistic as we're heading through the remainder of the year.
Thanks, Jim. And what about this Magnificent Seven performance and earnings dynamics?
Oh, yeah, it's been very interesting, Mike, as Jim had mentioned, as we look at the Magnificent Seven specifically. So here we're talking about Apple and Amazon and Google and Meta, which is Facebook, and Microsoft, NVIDIA, Tesla. So these companies make up a very large part of the S&P 500 now. The S&P 500 is, of course, a weighted index. So as the market capitalization of these companies continues to grow, they are more impactful of the S&P 500 overall. And that certainly is played out during those very strong years in 2023 and 2024, where we saw the S&P 500, as I'd referenced earlier, 2023, we were up 24%, 2024 up 23%. But actually, if we strip out the performance of those Magnificent Seven companies, so only taking out those seven companies, the S&P 500 was only up 8 and 10% over those years, respectively. And certainly 8 to 10% returns in the S&P 500 are attractive as an investor, but nothing like we saw with the performance of the Magnificent Seven, up 76% and 48%. Now, of course, on the upside, as we see that performance, it's going to be the same thing on the downside. So as this tariff discussion came into play in the first quarter of this year, the Magnificent Seven certainly pulled down markets pretty substantially. But we've since balanced out where we're seeing in the 5% range. This is, of course, as of the end of the second quarter, June 30. We're up about just north of 7% at this point. So it has been interesting how impactful the Magnificent Seven has been. As we look at earnings going back to 2021, here we see, well, actually going into 2023, where we start to see those very strong earnings from the Magnificent Seven. That's when we started to see that substantial growth. But to Jim's point, as we look at what's projected for the end of 2025 and into 2026, more moderate growth, at least relatively speaking, and we'll see what that does to the stock price from a performance standpoint over time. As we look at performance dispersion, this is also interesting, as we saw NVIDIA being the best performer over the past 3 years. That certainly was the case in 23, 24. And on a year-to-date basis, NVIDIA is still the strongest performing Magnificent Seven as they continue to push AI technology and really bringing the whole market with them at this point. But for the Magnificent Seven, as we've looked at the first 2 quarters this year, it's really been a mixed bag in terms of performance. We saw, again, NVIDIA being a top performer, but we saw Amazon kind of at the middle of the road. But actually the worst performer was, again, Tesla, as we see kind of maybe a tilt in the direction of electronic vehicles, battery-powered vehicles, at least the sentiment of the buyer, and then also some political aspirations that occurred for Elon Musk. But actually, Apple has had a very challenging year this year, year to date. So it'll be interesting to see the way the rest of the year plays out.
Excellent. Thanks, Chris.
Yeah, so kind of building on conversation around valuations in the Magnificent Seven. On slide 7 here, we're looking at the spread of PE ratio in the S&P 500. The average or the median spread for price to earnings ratio historically has been around 11.7 times. Right now it's at about 16.6 times, which is a pretty significant delta between the average and where we sit right now. Kind of building on the conversation around the Magnificent Seven, because these growth or tech stocks are trading at such high multiples right now. For example, NVIDIA is trading around 55 times price to earnings ratio at the moment. It's creating an environment where spreads are extremely wide from the lowest price to earnings ratio to the highest price to earnings ratio in a market. And as 401k plan consultants, when we see spreads this wide, it really makes us be thoughtful about picking good active managers in areas like value or growth sectors of the market because there is opportunity to be had when we see spreads become this wide. If something's trading at a significantly higher price to earnings ratio or a significantly lower price to earnings ratio, there could be some intrinsic value that can be found by an active manager to drive future performance. And so, in markets that may look, I'll say, less normal or efficient to where we've been historically, it just creates opportunity for active managers where it makes sense. So, again, at LoVasco, we use both active and passive investment managers in our 401k lineups. We're very strategic about where we are using active managers. But again, when we're sitting in positions like we are today, seeing spreads this wide just makes things very advantageous for some of the managers we evaluate.
So looking at where the returns are coming from as we break down, so these are style boxes. These are originally generated through Morningstar, but they represent large size companies, mid size companies, small size companies, all US domestic in this particular case. And then we're looking at the different styles of investing, either value or growth. And blend in the middle is typically going to be your indexes. As we look at the graph to the top left, it illustrates the 10-year annualized returns in each of those individual sectors. And really over that time, and really going back to the financial crisis, we saw much more emphasis on large cap growth style investing. That's where a majority of the returns in the markets overall were coming from. As we continue to see this trend of investment into technology, you can see the growth really dominated the marketplace. Value had fallen out of favor. So value investing simply meaning that the managers of these particular funds are looking for companies that they feel are trading below what they're actually worth. So whenever we see value, we're always talking about bargain shopping in a lot of cases. These companies are dividend paying, typically are going to be high quality, long-term investment companies. But growth has really dominated that space. But as we move to the year to date in the middle, we see that we've since kind of balanced out. We're seeing much more levelized investment in both growth and value in the large cap space. Still moving toward growth in mid caps, and small caps have continued to struggle. Although we anticipated stronger returns in the small cap space moving into 2025, we really didn't see the interest rate reductions that we thought we might, which are very impactful for small cap companies due to their floating rate debt. So that's where we're at from a valuation and return standpoint. So moving into the economic growth and really gross domestic product, this graph represents GDP going back to 2001. And we've really been on trendline growth of just north of 2% for that entire period, with the exception of the COVID years, where obviously everything had stopped. As we moved into the first quarter of 2025 and the tariff conversation started to play out, we did see a little bit of a reduction in GDP. We're still projecting out more tempered growth throughout 2025, probably in the 1.5% range. With the U.S. consumer being the biggest driver of GDP overall. So you can see on the bar graph to the right, U.S. consumer, that's you and I, in the market buying goods and services, makes up about 70% of overall GDP in terms of what we're consuming. And the U.S. consumer is going to continue on that path until they can't spend anymore. So we've really seen that over time that, regardless as to where individuals are at as far as credit card debt or those types of things, they are still going to continue to spend dollars in the market until they can't. So looking at consumer finances overall, you can see on the bottom right, we've started to see an uptick in certain delinquencies, specifically auto loan defaults, credit cards, and we've seen a dramatic shift in student loan debt default. So, of course, you recall during the COVID years, there was a reprieve on paying back student loans. That went back into effect where we had to start paying back those loans in October of 2023. since that time, we have seen a drastic increase in those student loan defaults. So it's indicators like this that can be concerning as we start to see a pullback or any kind of a pullback in consumer spending, the impact on GDP that would flow into obviously unemployment as it affects corporations and could lead us down a negative path in terms of recession. It's just an indicator that we want to take a close look at.
If you can keep going on labor demand.
So this represents the JOLTS report. This is a monthly report that's generated, that's an acronym for Job Openings, Labor Turnover, and it's an indication of what the labor market is doing. So you can see on the graph to the left, this represents job openings. So it's an indicator of the openings that companies have relative to the workforce that's available. So you can see as we peaked out in March of 2022, the number of outstanding jobs that were open. We've had a significant decline since that time. That can be several factors as we look at the efficiencies of companies and as technology more comes into play. But we have seen during periods of significant decline is often followed by a recession. So that's another indicator that we want to take a close look at. The JOLTS report also represents quits, which is an indication of what individuals are doing if they're leaving their jobs. And as you can see here, as we were coming out of COVID, we saw a dramatic increase in quits. This is often an indicator that individuals are comfortable in leaving their jobs because they're extremely confident that they're going to be able to find another job. So as we've seen the quits report decline, that is more of a sentiment in terms of the workforce that I might not be happy with where I'm at and I might want to do something different. However, I'm not confident that I'm going to be able to find something comparable if I leave this job. So that's an indicator of sentiment as it relates to the labor market. And then, of course, layoffs, which represents the contraction of companies. We're starting to see an uptick in layoffs, just slightly going back to the COVID years. But it is another indicator as it relates to where we're at in the labor market.
Jim, let's talk a little bit about AI.
Yeah, so AI, I'm sure everyone's heard a ton about AI over the last year, 6 months, and it's because it's growing really rapidly. On slide 12, on the left-hand side of the page, the chart we're looking at is showing us some historical capital spending and then some longer-term projections for capital spending among 4 of the largest AI players, Alphabet, Amazon, Meta, and Microsoft. If you look at the data here on the page, I mean, you can see that just in the last 5 years, the spending in AI has almost tripled from 2020 into 2024, and then it's going to potentially quadruple from there in 2025 and beyond. And so the investment into AI from some of the larger players is not slowing down anytime soon. And if we look at the application and how this is being used by different businesses to scale, to become more efficient, on the right-hand side of the page, this is showing us from September of 2023 into June of 2025, and then projections in the next 6 months, just how rapidly this has increased. So, obviously, IT or tech has seen the largest growth, 27 and 22%, but across the board, we're seeing a 9% increase in tech utilization among businesses in just about a year and a half, 2 years time. So it's growing rapidly. It's a huge component of both business growth, economic growth, and ultimately, we talked a lot about the Magnificent Seven and these tech names, but the companies that are leading the way from an AI perspective, the NVIDIAs, the Amazon, Meta, Microsoft, Alphabet, they are also leading the stock market. So this is something to continue to grow and something we need to keep learning more about, particularly from an investment perspective.
Yeah, that's good stuff. Jim, if we transition to the Fed and interest rates, what do we have here?
Yeah, so interest rates feels like something we've been talking about for the last 3 or 4 years because we have. Starting in 2022, we saw some very aggressive action with respect to interest rates to combat the record high inflation we were facing as a nation. So, looking at our chart here, this is just showing us historical interest rates going back from 1993 up through 6/30/2025, and then we have projections going out into 2026 and beyond. But again, in 2022, we saw the really aggressive rate increases to combat the inflation we were facing as a nation. As we got into the later stages of 2024, we actually saw inflation get down to a very competitive range. It was, in that 3% range that the Federal Reserve was targeting, and we saw them take action and cut interest rates before the end of the year. And this put a lot of energy and optimism into the market. We saw a bit of a rally to close out the year. And there was an expectation that interest rates were going to continue to fall in 2025, which is typically a really good thing for the stock and the bond market in the short term. However, that has not happened. And we talked a little bit about this earlier, but as the news around tariffs came about, there's a lot of question marks and fear on how this may affect our overall economy, and particularly the cost of goods in our country. If these tariffs were to increase the cost of goods, and we also had an economy with decreasing interest rates, which promotes spending and also increases the cost of goods when there's additional spending in the economy, these two forces working together could really put us in a position where inflation and the overall cost of living could become, really out of line for most consumers. And so the Federal Reserve provided updated guidance that, they're going to be looking at interest rates on a day-to-day basis based off of, true economic data. There is no set agenda for what they're going to do with rates. They're going to look at things like employment, wage growth, consumer confidence, to determine what they want to do with interest rates and how it's going to be treated. However, if you've been following this in the news at all, you'd see that President Trump has been very open over the last few months about placing pressure on Jerome Powell of the Federal Reserve to decrease interest rates because it is a very strong lever to pull to help influx the overall economy and the stock market. If we just think about how this can affect our economy and stock market for a moment, again, when interest rates decrease, this helps promote spending in the overall economy. It makes accessing capital much cheaper for consumers, whether that's a mortgage, etc. And so it does generally influx cash into the economy. From a stock market perspective, it has a similar effect for businesses, particularly the growth sector or smaller companies, so the small cap sectors of the stock market. When interest rates fall, the cost of capital for businesses, again, particularly growth, who are leveraging a lot of debt on their balance sheet, the cost to access that capital becomes a lot cheaper. Their balance sheets look much more attractive to investors, and so we generally see the stock market, particularly the growth sector, really take off. And then finally, how it affects the bond market. If we move along to slide 14, interest rates and bond prices work inversely. So let's just focus on the right-hand side of slide 14 and look at what happens when we see increases by 1%, decreases by 1%, and no changes in interest rates among different types of bonds. So again, bond prices and interest rates work inversely. So when we see interest rates fall, we're going to see the prices of bonds rise. And typically, longer duration bonds are more interest rate sensitive than shorter duration bonds. And so as an example, if we start by looking at a 10-year U.S. Treasury on the page, historically, when we see interest rates fall by 1%, we see about a 20.8% increase on the price of that bond. Conversely, when we see interest rates rise, about 11.2% negative effect. But again, if we were to see interest rates start to fall, there will be, again, a short-term prop for the bond market from a price perspective. However, from a long-term standpoint, this would reduce the yield that consumers are likely going to see when purchasing newly issued bonds as they come available.
Thanks, Jim. And how about the yield curve? How does that relate to everything here,
So
Chris?
this represents what is the yield curve. So if we look at the horizontal across the bottom, moving from left to right, we see the duration of treasuries. So you can see 3 months and under, those are typically going to be your money markets. As we continue left to right, you see 2 to 5 year treasuries. Those are going to be your stable value accounts, which is what we typically use in 401k plans as a cash option or an option where participants can, or those that don't want to take on any equity risk, has a place to move their dollars. We continue left to right, you see the 10-year treasury in the middle out to the 30-year treasury. Now, a normal yield curve would represent short-term treasuries, so 3 months, 1 year, are going to be yielding less than what we would see, say, on the 30-year treasury. So that would be a normal yield curve. Now, we inverted in the yield curve in June of 2022. And we've been inverted for that entire time. We really saw a significant amount of investment into the short end of the curve as we saw of these significant interest rate raises from the Fed. And really, for the first time since the financial crisis, you were able to get some interest on cash, which we were not able to do for a number of years. We had to take on, in a lot of cases, more equity risk than we wanted to see any kind of growth. So we saw a lot of investment into the short end of the curve to capture some of those interest rates, and that pushed yields higher. So you can see at the peak inversion on the green line, this would have been of July of 23, about a year after we saw the inversion of the yield curve. We were just north of 5.5% on short-term treasuries or money market accounts. And then we were at under 4% for 30-year treasuries. So that is obviously inverted. We have since seen this start to normalize. So you can see as of the end of the quarter, June 30th, we're at about just under 4.5% for short-term treasuries and 4.8% for long-term treasuries. So we've since normalized that yield curve. As we had talked about in terms of our guidance on maintaining a stable value account in the 401k, and this is exactly the reason that we would do that. So that we had a lot of questions from clients. Should we be moving our money market account or to a money market account from the stable value? Our guidance was no, that this will normalize at some point. Stable value accounts by design are to outpace money market accounts and are generally going to be a better investment on the cash side for participants. So we will continue to see this normalize throughout 2025.
Thanks, Chris. Jim, you want to talk to us a little bit about global equity markets?
Absolutely. So a lot of times when we're talking with clients about building either custom target date models, or we're talking to plan participants about building them a diverse portfolio for their 401k, the U.S. equity markets typically dominate the conversation, and there's frankly sometimes hesitancy to invest in international markets because U.S. markets have outpaced them historically. If we look at the table on the left-hand side of the page here, what we're looking at is the U.S. stock market in comparison to some of the different regions around the world. So we have the ACU World ex-US, which is all countries except for the United States. We have the EFI, which is Europe, Australia, and the Far East, the Eurozone, and the emerging markets. We're looking at the average annual return over the last 15 years, looking at the return from 2024 and the return from 2025. So historically, the U.S. markets have dominated the global scale. Over the last 15 years, about 14.9% compared to the highest peer, the Eurozone, at 8.6%. This was also true for 2024, up around 25%, versus emerging markets, the closest second at 8.1%. However, through the start of 2025, as there's been question marks and concern about how these tariffs are going to ultimately impact the U.S. economy, we've seen a shift, and some of the international markets are significantly outperforming U.S. markets. U.S. stock market through Q2 of 25 is up 6.2. Again, Eurozone's up about 28.7, and EFI at 19.9. And so, seeing these numbers, it just emphasizes the fact that we try to reiterate with our clients that it is important to have some international exposure in portfolios when we're saving for retirement, because they offer that uncorrelated asset to the U.S. markets. During periods where the U.S. markets were struggling to start 2025, the international markets are performing very well. So from a diversification and a portfolio construction perspective, it just remains true that it is very important to have this international exposure, just to give us that uncorrelated diversification across the board. So we can also see, as we get into some of the select countries, how this plays out at a more granular level.
Thanks, Jim. If we stay with global equities, talk to us a little bit about valuations.
So here it represents global equity valuations. Now, Jim had mentioned and really provided detail on what we are seeing in U.S. domestic valuations, how they have really gone well beyond their 20-year average and have gotten quite expensive to buy into. You can see the U.S. markets on the graph to the left. We're trading about 22 times earnings. However, if we look at developed economies around the world, especially major financial markets, you can see that their valuations are much more in line with their 20-year range. They have not really exceeded the boundaries with like what we've seen in the U.S. And for that reason, again, as Jim had mentioned, it is a non-correlated area of the market to invest in outside of U.S. domestic. But we did see, as we went through that tariff discussion, a lot of inflow into international markets. We weren't seeing sell-offs in the U.S. necessarily, or individuals liquidating their positions in, say, the Magnificent Seven, but we did start to see a significant amount of investment into those international markets, in large part because of the valuation measures are much more attractive. So as we look at where valuations are by sector, and this is a measure of each major area of the market, so we're talking about healthcare and financials, getting into consumer staples and consumer discretionary. But it measures international markets, specifically the MSCI, which is the Morgan Stanley Capital Indicator, and how that is measured against the U.S. markets as far as the S&P 500. So you can see, using an example, if we look at the index overall, you can see that the MSCI is trading at a 35% discount relative to the S&P 500. So much more attractive from an investment standpoint. And there you can see the sectors really across the board, with consumer discretionary really being the most dramatic, where it's trading at a 50% discount to the S&P 500 overall. So that is a significant indicator of how investment might flow into international markets.
Well, thanks, Chris. And then just to wrap it up, talk a little bit about earnings for us.
So earnings here represents, again, major developed economies around the world. And what we've seen really since 2020 kind of is the baseline and what kind of growth we've seen with those particular economies, with India's growth really being quite substantial as we moved from 2021, coming out of the COVID years, into 2025. You can see China has lagged a bit. China had a very robust growth period as we moved through a majority of the 2000s, but has since lagged, where we're not seeing as much expansion as we have with some of the others. Looking at earnings growth expectations as we move into 2025 or through 2025 and into 2026, you can see that India, we're still anticipating rather significant growth. But China is anticipating bouncing back. So it'll be interesting to see the way that plays out and how that impacts international financial markets.
All right. Thank you again to Chris and Jim for walking us through these key items pertaining to retirement plan sponsors. And until next time, thank you for joining us, and we'll see you in the next episode of the LoVasco Briefing.